Welcome to Financial Counseling Unit 6, Taxes. Let's start with federal income taxes. What we want you to do in this lesson is recognize key tax terminology, understand requirements and benefits of filing as head of household, applying for credits and refunds, claiming dependents, identifying resources for tax filing and planning assistance. Let's start with income. The first type of income is earned income, and that's income that can come from wages, whether it's tips, salaries from a job, or whether it's from self-employment. The second type of income is unearned income, and that income can come from capital gains, Social Security, your unemployment, interest, child support, and alimony. Finally, we have gross income, and that's pre-tax wages. So it's before any deductions come out. It's self-employment as well. It's income from interest. Also, unemployment is considered gross. So you'll see some overlap here. Gross income can be earned or unearned, but it does not include Social Security income. It does not include, not Social Security, disability income. It does not include child support, tax refunds, or gifts. Now let's talk about filing status. You can file single, which means you are not married on the last day of the tax year. So you can be married from January 1st through December 30th of 2014. As long as your divorce is finalized by December 31st, you can file single. That also includes whether you're widowed or, of course, if you were never married. A qualifying widower is another filing status, and you can claim this for the first 2 years after the death of a spouse, as long as you remain unmarried and you have a dependent child. The next one is married filing joint, and that's a couple that's legally married, again on the last day of the tax year. And then you have married filing separately, which means they're married on the last day of the tax year, but for whatever reason they chose not to file together. Not usually more beneficial for them, but people have their reasons for why they want to do it. So sometimes it may be that one spouse owes a large tax bill and the other one actually would have some refund coming to them. So instead of having it getting eaten up by the tax bill, the one who owes money may set up a payment arrangement with the IRS while the other one files separate so they can get their refund. So that's a reason they might choose to file separate. Now the next thing is, when do you have to file? Do you have to file? Is it a requirement? Well, you don't have to file if your income is under the threshold, and these are the limits. As a single person under 65, if you're making less than $9,750 a year, you don't have to file. If you're married and together you make less than $19,500, you don't have to file. And then, of course, if you're head of household and you're making less than $12,500, you don't have to file. Self-employment's a little bit different. If your income exceeds $400, then you have to file. So that's something you just want to be mindful of. It's a little different for self-employed people, and it just has to do with some of the things self-employed people have to pay. All right, let's see. Let's do an example here. Todd is single, and he has no children or dependents. His income for 2011 was $5,400 and $550 for unemployment. Is Todd required to file? Pause this just for a second, work this out, and then come back. All right, so I'm assuming you're coming back. Let's see what the answer is. No, Todd's income is less than $9,750, so he is not required to file. However, he may have some refund due him, so it might be advantageous for him to file to get his refund. Let's talk about deductions and exemptions now. A deduction reduces taxable income for expenses such as medical, property taxes, mortgage interest, donations, alimony. Standard tax deduction, which is what the IRS gives you if you don't itemize, is $59.50 if you're single, $8,700 if you're head of household, $11,900 for a married couple. Renters usually can't itemize, so the tax credits are very important. Exemption. Now there are two kinds of tax benefits that reduce taxable income by $3,800 per exemption. There's a personal exemption and then there's a dependent exemption. Now let's talk about tax credits a little bit. A credit actually reduces the amount of taxes you have to pay, refundable or non-refundable. A refundable tax credit is a credit given to a taxpayer even if the taxpayer has no taxable income. Any excess is refunded. An example of that is earned income tax credit. A non-refundable tax credit is a credit that can only be used to reduce the income tax. So if the credit is more than the actual tax owed, then the excess credit is lost and does not increase the refund, such as education tax credits. So with education tax credits, you can only offset the amount that you paid. Does that make sense? All right, let's move on. So what's the difference, you ask, between a deduction or exemption and a credit? Well, deductions and exemptions reduce the amount of income that's subject to tax, whereas a credit directly reduces the tax that you owe and may result in money to your clients even if they had no taxes due. All right, tax refunds. That's where everybody gets excited. If there is a prior year earned income but no tax return was filed, they have up to 3 years to file that return and get that refund. So for example, if a claim for a refund expires 3 years from the due date, and for a 2009 return, taxpayers have until April 15th of 2012 to claim that refund. If they're missing a W-2, they can usually get it from their employer or the IRS. Now let's talk about head of household, because we'll see that a lot with most of our clients who are single parents. It's reserved for unmarried individuals paying more than 50% of the costs of keeping up a home for a qualifying person. And we're going to talk about what a qualifying person is in a minute. It offers a lower tax rate, a higher standard deduction than single or married, which we noticed when we went over that. The requirements are they have to be unmarried, divorced, or legally separated, or considered unmarried based on a special exception, which we'll talk about on the next screen. And they have to provide a home for a qualifying child or a relative. Now, the special exemption for unmarried is, and they have to meet all of these, does not file jointly with the spouse, paid over 50% cost of keeping up his or her home, did not live with the spouse for the last 6 months of the tax year, live with the child for more than 50% of the tax year, and claims that child as a dependent. So all of those have to be true. And then the second option, they have to maintain a household, and all of these also must be true. Must have paid over 50% cost of the upkeep of the home for at least one qualifying person, and that includes rent, utilities, groceries, that sort of thing. The qualifying person must have lived in the taxpayer's home for at least 6 months. So those are the two requirements if you're not technically unmarried. All right, so now let's talk about who's considered a qualifying person. First, taxpayer's child. So if they're unmarried, an unmarried child. So of course if the child is married, then they're filing joint with their spouse. But if they're unmarried, they're living in the taxpayer's home, then they're a qualifying person. They have to be under the age of 19 or 24 if they're a full-time student, or there's no age requirement if they're disabled. They must be the taxpayer's child, stepchild, adopted child, foster child, sibling, step-sibling, or descendant of any of these relatives. They must live with a taxpayer for 50% of the tax year. They cannot provide more than 50% of their own support. And they must be either a U.S. citizen or a citizen of Canada or Mexico. Okay? Now, Category 2, another way to qualify for a qualifying person is a taxpayer's parent. Now this person does not need to live with the taxpayer, but they must be the taxpayer dependent under the rules for qualifying relative. And then qualifying relative includes grandparents, sibling, in-laws, uncles, aunts, nieces, nephews, and children, or other relatives, excuse me. Older children who do not meet qualifying child definition. They must live with the taxpayer, again, a minimum of 6 months of the tax year. Their gross income has to be under $3,800. So if it's not a child and they're using a parent or another relative, their income has to be under $3,800. Must be the taxpayer's dependent under rules for qualifying relative. So let's use an example. Marion's son Peter, he's age 28. He lived with her all year. Peter worked full-time and earned $35,000, which he spent on his car, dates, and entertainment. Marion provided over half of the cost of maintaining the household. Can Marion claim head of household filing status? Make sure to give your reasons. All right, now pause this recording and work this out and then come back to the answer. Okay, so hopefully you've gotten the answer. Let's see what it is. Peter, of course, is way too old to be her qualifying child because we said under 19 or under 24 if a full-time student. Plus, does he make more than $3,800? Yeah, he makes $35,000, so he makes too much to be a qualifying relative. So did you get that right? All right, let's look at what are other possible solutions. Joe and Sally are married with 2 kids. Joe lost his job in January 2012, so they had a lot less income. Should they file a tax return? His wages were $856, her wages were $1298, his unemployment was $3948. Wow, in this day and time, it'd be hard to figure out how they must have had the house paid off. Because otherwise, whew, that would be tight. The house paid off in an organic garden. All right, pause it, come back, and see what the answer is. Okay, hopefully you've worked that out. They are not required to file because their income is less than $19,500, but they earned income, and so they should file for a refund of their withholding, as well as any appropriate tax credits because they have children. So it may be a good idea for them to file, even though they're not required. All right, here's another one. Mary is single and has 1 baby. Mary made about $2,500 doing child care in her home. She also has a W-2 for her part-time job. Does she have to file? Why? Now let's look at her income. She's got $2,500 self-employment and $364 from her wages. Does she have to file? All right, go ahead and pause this, work it out, and then come back to the answer. Okay, Mary is required to file a return. Why? Because her self-employment income, which is the child care, is over $400. But she may also qualify for tax credits, so it's a benefit to her to file. The next one is Susie is single and retired. She started receiving Social Security at age 65 in 2012. Should she file a tax return? Why or why not? She gets $85 in interest, $1,293 in wages, and then $4,400 in Social Security. All right, pause this and then come back to the answer. Okay, the answer is Sue is not required to file a tax return because her income is less than, her gross income is less than $9,750. However, because she's earned income, she should file and claim a refund for her withholding as well as any potential tax credits. So how are you doing so far? Hopefully pretty good. Let's move on. Clients can claim exemptions on the following. Self, on their personal exemption, unless qualifies to be claimed as a dependent on another taxpayer. So for instance, you can claim yourself when you file your taxes unless your parents are claiming you or someone else is using you as a qualified dependent. You can claim yourself on a joint return, so 2 personal exemptions are claimed for husband and wife. Personal exemption reduces taxable income by $3,800. You can claim an exemption on others, which we talked about, qualified dependent exemption. And that's someone other than your client or your client's spouse. It can also reduce your taxable income by $3,800 for every dependent. They must meet qualifications based on age, income, relationship, support, and residency that we talked about already. So let's look at this next example. Hester is a single mom with one daughter, age 5. Hester and her daughter lived together all year. Hester's father also lived with them all year. Her father's total income was $3,000, and Hester provided over half of his support for the year. How many and who are the dependents Hester can claim? All right, pause this recording, work this out, and then come back for the answer. All right, we're back. Hester can claim 2 dependents. She can claim her daughter as a qualifying child and her father as a qualifying relative. Jenny and Bill want to know how many exemptions they can claim on their joint return for 2012. They have 3 children, 4, 7, and 9, who live with them all year, and the children did not provide any of their own support. All right, so how many can they claim? How many exemptions can they claim on their joint return? Go ahead and pause this and then come back for the answer. All right, we're back. Jenny and Bill can claim 5 exemptions because Jenny and Bill can claim their own personal exemptions plus dependent exemptions for their 3 children since they passed the 4 tests: age, relationship, residency, and support. Make sense? All right, let's move on. Jason is a 21-year-old student who's been attending college full-time for 2 years. He lived with his parents for all of 2012, and he earned $10,500 at his part-time job. He acknowledges that his parents spent more on his support than he did, but feels that since he is 21, he should be able to claim himself on his own return for 2012. Can he? All right, pause this for a moment, work this out, and then come back for the answer. All right, we are back, and the answer is no. Jason cannot claim his own personal exemption. He passes all the tests to be the qualifying child of his parents: age, relationship, residency, and support. All right. You know, one thing that we see quite often in the housing counseling arena with regards to income taxes, and this is kind of a red flag, especially if your client is a first-time home buyer, because oftentimes programs will want to see their last 3 years' tax returns to prove they're a first-time home buyer. Now, they're looking mainly for mortgage interest deductions to make sure they haven't owned a home, but they will also look at filing. And if there's a couple, a married couple, and they filed head of household, then this can prevent them from qualifying for a first-time homebuyer program. So something just to be mindful of when you're working with your clients. Make sure that if they're a couple, they file joint or they file married separate, married joint, but not head of household. Because I've seen many times where our housing finance agency, our state housing finance agency, required that the couple refile their taxes as joint, and it reduced how much return they would have gotten, and they ended up having to pay money. And they're being advised to do this. They didn't do this on their own. They went to, you know, one of those tax places that pop up right around tax time, and they told them, oh, to get the most money back, file head of household. Well, you can do that if you're single. You can do that if you're single, or if you meet those qualifications for married and filing, but you can't. That's something you just have to be mindful of. Okay, so I just wanted to bring that to your attention. Let's move on. All right, so Jason says that he talked to his parents and they promised that they will not claim him as their dependent for 2012. Can Jason claim his own personal exemption on his return? All right, pause this and come back to the answer. We're back. No, Jason still cannot claim his own personal exemption since he passes all the tests to be the qualifying child of his parents. He can be claimed as a dependent whether they do claim him or not. So that's interesting because I know I'm thinking about myself when I was a young person and I went off to college. I think I filed, but you know, I was off at college, so that's why I didn't pass the residency test, because I didn't live with my father full time. I was, just for a second I was like, oh no, did I file my taxes incorrectly? But I think I'm okay there. Let's move on. All right, so the next one is Salvador is single and has an I-10 number. So that's not a Social Security number, it's a tax ID number. He lived in the U.S. all year and earned about $30,000. He sent his money to his widowed mother who lives in Mexico. He sent her $1,000 a month for all of 2012, which constituted all of her support. His mother has an I-10 tax ID number. Salvador wants to know if he can take a tax deduction for the money that he sent to his mother. Go ahead and pause this, work this out, and come back for the answer. All right, we're back. Salvador can claim his mother as his dependent. She meets the 5 criteria. Income is less than $3,800, no joint return. She has Mexican residency, even though she doesn't live with him. She's his parent. He paid at least 50% of her financial support. So I'm sure that's one you probably hadn't thought about. It's like, oh, she lives in Mexico. He's just sending her money. No, he can't. Absolutely, he can claim her. Yes. All right, let's look at this one. Tom and Mary are the parents of 2 foster children, a girl age 5 and a boy age 9. The boy has lived with them for 2 years. The girl was placed in their home in November of 2012. They want to know if they can claim both children on their tax return for 2012. All right, pause this and come back for the answer. We are back, and the answer is they can claim the boy as the dependent because he meets the requirements of the qualifying child: age, relationship, residency, and support. They cannot claim the girl for 2012 because she did not live with Tom and Mary for more than 6 months. Remember, that's the caveat, is the 6 months. Had she moved in with them in July, then yes, or June actually. Well, 1st of July. Let's say June 30th. If she moved with them June 30th, then yes, they could have claimed her. But since she didn't move in until November, then no. Is that starting to make sense? Good. All right, let's continue. Tax benefits for low-income workers. We've got EITC, Earned Income Tax Credit. This is a refundable tax credit that reduces tax liability even if there is no taxable income. EITC taxpayers may receive a refund even if they never paid any taxes or had any tax withheld. It does not affect eligibility of benefits, so that's nice. It's not dependent on size of family. They must have a Social Security number. It's higher for families with children. So based on 2011, if they don't have children, it's $464. If they do have children, it's $3,094. For 1, 2 children is $5,112, and 3 children, $5,751. So you see, pretty good. So if a single parent with 3 children didn't pay any taxes at all, they could still get $5,751 back. And so this just shows a range, a number of kids if you're single or if you're married, and then the range of the earned income tax credit that they can receive. All right. You may want to just take a screen print of that, but it should also be in your book as well. Advanced earned income credit. Well, this used to be an option. Workers get part of the earned income credit refund in their paychecks throughout the year, then receive the remainder after filing, but that was repealed in August 2010, so that's no longer available. So you want to verify if your clients have used it and how to get their refund. Here's another example. Jenny, a single parent raising 2 children, earned $12,200 in 2012. Is she eligible for an EITC refund? And if so, what is her possible EITC? Is this significant? All right, pause this now and work it out and then come back with the answer. We're back, and the answer is Jenny's EITC is $5,236, a significant 41% increase in her family income. So yes, she'll definitely want to make sure she files her taxes, right? All right, let's continue. Child tax credit. That's a non-refundable credit of $1,000 for taxpayers with dependent children under the age of 17. When the full $1,000 is not used to offset taxes, leftover can sometimes be used as refundable additional child tax credit. Additional child tax credit is a refundable tax credit available to those who don't use the full child tax credit, and the amount of credit is based on a percentage of earned income not exceeding $1,000. It's available to those with the social or tax ID number. Making Work Pay is another program for low-income people, credit for child care, tax benefits for homeowners, residential energy credit, retirement savings contribution credit, as well as education tax credits, also known as American Opportunity Credit or Lifetime Learning Credit. So these are things that you want to just make sure you share with your clients, let them know these are things they might qualify for, especially if they're a homeowner. Then there may be a tax benefit. If they have energy efficient appliances, there may be a tax benefit, etc. All right. Another example. You're starting to see, you learn by doing. So we're giving you a lot of examples so you can kind of see these and how you can approach them with your own clients. So Jeremy and Annette and their 3 children, ages 3, 5, and 7, lived together for all of 2012. Annette's wages were $18,000 and Jeremy's unemployment was $6,000. His grad school tuition and fees were $3,000. Are they required to file? Should they? Why or why not? All right, go ahead and pause this and then come back for the answer. Jeremy and Annette are not required to file a tax return. Married filing joint income less than $19,000. They qualify for 1, the earned income tax credit, 2, additional child tax credit, and 3, an educational tax credit plus withholding deductions. So it would be a good idea for them to file. Next one, Sally is a single mom with a son, Zach, age 2. In 2012, the 2 of them lived together all year. She earned about $14,000 at her job. Her ex-boyfriend, who she's not seen for over a year, told her that he already filed his tax return and claimed Zach. Sally is upset because she was planning on a big refund. What credits could she qualify for? What credits does her ex qualify for? And what should she do? Pause this and come back for the answer. Okay, now this is something I know we've seen before, or I know I have seen before. Hopefully you've seen it too, where a single mom, for whatever reason, this ex, whether it's the ex-wife or the ex-husband, etc., files and claims the child even though the child didn't live with them. So in this case, Zach is Sally's qualifying child for dependency exemption, period. Number 2, she can get the child tax credit and the earned income tax credit. Zach is not the boyfriend's qualifying child because he does not pass the residency test. This is true even if the boyfriend is Zach's father. Sally should go ahead and file her tax return claiming Zach. If the IRS questions this, she should contact a low-income taxpayer clinic, LITC, to get assistance supporting her claim. Make sense? So she shouldn't just not file and include Zach. What her ex did was fraud, because basically by him filing his tax return and claiming Zach, he's saying that Zach lived with him for at least 6 months out of the year, which did not happen. All right, let's move on. Tips for choosing a tax preparer. You want to choose by a professional designation and experience. So you want to make sure it's a tax attorney, a CPA, an enrolled agent, businesses specializing in tax preparation. Ideally, you want to refer your clients to maybe the Volunteer Income Tax Assistance Program, VITA. Many nonprofits actually do that as a service, so if your agency does it, then great, but if not, you can refer them to one of those. Tax counseling for the elderly is another free service. IRS offers a free file alliance that's done online, and then the low-income taxpayer clinic. Oftentimes libraries, I've noticed, will also offer free tax assistance. So consider avoiding currency exchanges, payday lenders, even at traditional banks. car dealerships, and they'll say, oh, you can file your taxes here, but what they're trying to do is get your client to buy a car. Independent preparers with no credentials. So sometimes you'll see notary publics, and they'll, they have no tax training, but just because they're a notary public, they think, oh, okay, we can do it. In some cultures, those are trained folks, but in the United States, that's not the case typically. Quick refunds or loans against refunds, refund anticipation loans, because they eat up such a big chunk of the money. Preparers who will not sign the return, which means they're not saying they're liable for misinformation. All right, so asset building options for your clients with refunds. This is a way of helping them not, I won't say blow it, but put the money in a not have cash in hand, so they won't be so likely to spend it. So you can encourage direct deposit to a bank account, ideally a savings. You can encourage them to purchase a U.S. savings bond. Form 888 can help them with the direct deposit. The treasurydirect.gov is another way of saving as well. So I highly recommend that you check out that website. It's pretty interesting. It's pretty interesting. I was actually not aware of it till recently, and I was like, oh my God, look at this. So, but these are ways that you can just kind of, what's the best way to say it? Just kind of softly recommend, don't just go on vacation or Vegas, but you know what I'm saying. All right, so let's continue. Another way is to recommend that they split it up, and this is probably the most likely to get buy-in from your client. Have them pay 30% of it in past debt, maybe things they might need to catch up, or pay down their credit cards, or just pay down whatever debts that they have outstanding. 30% can go into savings for future goals, and then 40% may be something that they can use today. So that way they feel like they get to use some of it, and they're not just, work hard all year and not get to use any of their money. So this one you'll probably get more buy-in on. Any questions? All right, that's the end of Unit 6. Thank you.